crude oil just punched through $100 a barrel for the first time in years. And if you think that's just a number on a screen, think again. This surge is about to hit your wallet, reshape trade flows across continents, and test whether central banks can keep inflation under control. The cause? Growing certainty that Washington and Tehran are heading toward confrontation, not compromise. Here's what happened. Benchmark US. Crude closed above $100 per barrel Tuesday following President Trump's stark assessment that the fragile ceasefire with Iran is on life support. The comments extinguished market hopes for de-escalation in the Middle East. Oil has now jumped nearly 30% since early February as tensions escalated from skirmishes to sustained conflict. Traders are pricing in the very real possibility of supply disruptions through the Strait of Hormuz, the narrow waterway that carries roughly 21 million barrels daily, about one-fifth of global oil consumption. Any blockage or military action there would instantly choke supplies to Asia and Europe. Markets reacted immediately. Energy stocks surged, with major oil producers like ExxonMobil and Chevron climbing 4 to 6%. But the broader market told a darker story. The S&P 500 dropped over 1% as investors calculated the inflation shock ahead. Bond yields fell as traders sought safety, pushing the 10-year Treasury below 4.2%. The dollar strengthened against most currencies as global uncertainty drove demand for safe havens. Gold jumped past $2,100 an ounce. This is classic risk-off behavior, investors bracing for economic pain. The winners are obvious but narrow. Big oil companies and oil-exporting nations just got a windfall. U.S. shale producers, Gulf monarchies, Russia, they're all collecting significantly more revenue per barrel. Tanker companies and shipping firms are also celebrating as freight rates climb. But the losers vastly outnumber them. Airlines face crushing fuel costs just as summer travel season approaches. Chemical manufacturers, plastics producers, and any business that moves goods, their margins are evaporating. Consumers everywhere will soon see higher prices at the pump, in grocery stores, and eventually across nearly every category as transportation costs ripple through supply chains. Globally, this hits unevenly. Europe and Asia import the vast majority of their energy, and they're now staring at a renewed cost shock that could tip fragile economies into recession. Japan, South Korea, India, and China are particularly exposed. Their growth depends on affordable energy imports. Developing nations face catastrophic impacts, forced to choose between fuel imports and food. Meanwhile, North American energy independence looks like a strategic masterstroke. Canada and the US, both net exporters now, gain geopolitical leverage even as their own consumers suffer at the pump. For jobs, energy sector hiring will accelerate. Expect drilling activity and oil field employment to expand. But manufacturing, transportation, and hospitality face headwinds as costs mount. Real estate markets could cool faster than expected if inflation stays elevated and central banks hold rates higher for longer. High mortgage rates combined with economic uncertainty typically freeze property transactions. Watch three things closely. First, any actual military action in the Gulf that sends oil to $120 or higher overnight. Second, the Federal Reserve's next meeting. Policymakers now face the nightmare scenario of rising inflation alongside slowing growth. And third, OPEC's response. Will Saudi Arabia and partners increase production to calm markets, or will they ride these high prices as long as possible? Those decisions will determine whether this is a temporary spike or the beginning of a sustained energy crisis. Stay informed, stay ahead. This is World Financial News.